Okay, so a few months ago, one of the first questions on my website was about taxes, and I knew I had to save it for tax season. And now we are here. They asked, we claim zero, we still max out our HSA, and we still owe at the end of the year. What is happening? And honestly, this one hurt my soul a little because I could feel their frustration coming through the computer. They thought they did everything right. They thought they dialed it in. They played by the rules. And the IRS said, LOL, still not enough. Give me your money. So today we're breaking down why that happens, what you can actually do about it, and spoiler, some of this applies to more of you than you think. I'm Tiamo, this is Tiamo Tries Money, and it is April 14th, which means yes, it is slightly too late to do anything about last year's taxes, but it is not too late to get your 2026 together. So I hope that we can give you a few tips to get you going for 2026 so you're not in the same seat next April. Let's go ahead and go. The rules changed and probably nobody told you. Okay, first, can we talk about the fact that claiming zero is kind of not a thing anymore? Back in the day when you filled out your W-4 at your new job, you had this little allowances system. You'd claim 1 or 0, and that determined how much your employer withheld from your paycheck for your taxes. Simple, right? Yeah, super basic. Well, starting in 2020, the IRS completely redesigned the W-4 form. Gone. The old allowances system? Gone. The I'll just claim 0, be safe strategy? Also gone. Or at least not how it actually works anymore. This change came from the Tax Cuts and Jobs Act of 2017, which eliminated personal exemptions. So the IRS had to redesign the whole form to match. Not helpful, of course. The new W-4 form uses your actual personal information, your household, your dependents, your other income sources, to try to figure out your withholding. They're trying to make it more accurate. Sometimes creates a little bit more of a problem. So here's the problem. A lot of people don't know that this happened. They're still mentally operating in 2019 thinking, I claimed 0, I'm covered. But the form changed, the rules changed, and if you haven't looked at your W-4 recently, your withholding might be completely off from what you think it is. So if you filled out a W-4 before 2020 and you haven't touched it, well, let's stop. Number 1, go ahead and adjust. We'll come back to this and all the details on how to do exactly that. Now let's talk about the HSA because I love that they mentioned it, and I love an HSA. I have an HSA. Maxing out your HSA is genuinely one of the smartest moves you can make. It reduces your taxable income. It's triple tax advantage. It's basically the nerdy overachiever of all retirement and health accounts. But, and this is a big but, the HSA reduces your taxable income, which is great when it comes tax time, but it does not eliminate it. So let me say that again for the people in the back. It reduces, doesn't eliminate. So if you're thinking, I maxed out my HSA, I should be good, you have removed just some of your taxable income from the equation. That is great. Honestly, maxing it out is great. But you still have the rest of your income sitting there, and depending on your situation, you may not be having enough withheld to cover what you actually owe the government. Same goes for you, by the way, for 401ks. Max it out too, obviously, if you can, that'd be amazing. Every dollar you put in your 401k comes out of your taxable income, so you're literally paying yourself and reducing your tax bill at the same time, which is beautiful. Do it. But both of these, they lower the target. They don't just make the IRS forget that you exist, which would be amazing if they did. All right, real life, why your situation is complicated. Oh, everything's complicated, right? Okay, I want to get personal for a second because this part really matters. My household is a lot. I don't know how else to say it. I have a rental property. I do 1099 consulting work. My husband's running his own side hustle business. Tax time is not the easiest thing for us. And at the end of the year, I don't want the IRS sending me a big refund. And most people say they want a refund, not me. Because you know what that actually means? That means I gave the federal government an interest-free loan for an entire year. No, thank you. I want that money working for me. I want to be using that money throughout the year. I do not want a refund. But I also really, really don't want to owe the IRS a bunch of money. Because as our friend in the comments discovered, that is a terrible feeling in April. So my goal every single year is to land as close to 0 as possible. I don't want a huge refund, and I don't want a scary bill. 0. And trust me, I get that this is not easy, and to get this perfect is even so much more complicated. And full transparency, I got it very, very wrong this year with so much of my consulting. Here's why this is hard for people like me, and maybe for you too. Dual income households are a nightmare for W-4 calculations. The form is designed with one earner in mind. When you have 2 people working and both have employers withholding taxes, the withholding doesn't automatically coordinate between the 2 companies, obviously. You can each look fine individually, and then you combine at tax time and suddenly, surprise, you owe some money. You can also go to the IRS website, and if you look up tax withholding estimator, it has helpful tips. For example, only one of you should be claiming the children on your W-4. You want to make sure that you don't have dependents on both. So this is a good place to start with if you work a regular W-2 employment. Side income makes it a little more complicated, if not worse. If you or your partner have freelance income, a side hustle, 1099 work, or maybe a rental property, none of that has taxes withheld automatically. And the IRS always wants their cut. So if you didn't set aside money or adjust your withholding elsewhere to cover it, that's where that bill comes in. And so definitely want to be on top of that as early as possible. That is exactly why I meet with my CPA throughout the year and coordinate, but at minimum every December. We look at where things are, we make any last minute moves, we try to get this number as close to zero as possible before the year closes, so I'm not really surprised. Let's talk SALT because this actually might apply to you. Real quick, I want to explain something called the SALT deduction because it came up in my own taxes this year and it might be relevant to yours. SALT stands for state and local taxes. It's a federal deduction that lets you deduct what you paid in state income tax and local property taxes on your federal return. For several years, the SALT was capped at $10,000 per household. If you live in a high tax state or own a home, you know that $10,000 really isn't moving the needle for you. Well, that changed. The One Big Beautiful Bill Act, yes, that is the actual name, it raised the SALT cap to $40,000 in 2025, and for 2026, it goes up to $40,400, and it will increase by 1% every year through 2029. And in 2030, it goes back to $10,000. So this is a big deal for a lot of households that couldn't get over that standard deduction threshold before. For me personally, this was actually the first year it made sense to itemize instead of taking the standard deduction. Between the higher SALT cap, the interest rate on our mortgage, yes, we bought at a higher rate, which actually means more deductible interest, and our donations to Big Brothers Big Sisters of Colorado, shout out to that amazing organization that I love to support, we finally crossed that line where taking the SALT deduction made a lot of sense. If you're a homeowner or you live in a higher tax state or make significant charitable contributions, run the numbers this year on itemizing for 2026. The math actually might look much different for you than it did a couple of years ago with that new change. All right, let's roll up our sleeves and get an actual action plan. Let's make this useful. Here's your 2026 tax setup checklist. Do this now while you're just kind of in tax brain mode in April. Number one, fix your W-4 if you should, for real. Go look at that one you have on file. If it's old or maybe your life changed, new job, got married, started a side hustle, had a kid, update it. The IRS has a withholding estimator on their website, like I mentioned before, and it's pretty decent, so go ahead and use it as a start. If you're in a dual income household, both of you need to do this together, not separately. Number two, max out your HSA and max out your 401k. Obviously, I know that's not possible for everybody, but if it is possible for you financially, I highly recommend it. If your employer offers these, hit the contribution limits. Every dollar in there is a dollar that the IRS doesn't get to touch, and it also builds your future. Win, 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 win. Number three, look at write-offs for things that you're already doing. Maybe donations you were making, home mortgage interest, business expenses if you have a side hustle. These are dollars you've already spent, so you might as well get credit for them with the tax guys. And number four, watch the One Big Beautiful Bill Act. This is real legislation with a real impact on your taxes. The SALT cap, like I talked about, jumping from $10,000 to $40,000 just in 2025 alone. If you live in a higher tax state or own a home, this could finally make itemizing worth it for you when it wasn't before. So just run the numbers, or if you have a CPA, have them do it for you. So to bring this all back to the original question that was asked of me, if you're claiming zero, maxing out your HSA and still owing, the most likely culprit is an outdated W-4, and maybe it just wasn't set up for the actual current household situation. Maybe you're both claiming the kids, for example, or not taking into consideration the second earner, and it's throwing off the math somehow. So I for sure would start there. And like I said, and the fact that tax reduction tools like HSA lower your bill, they don't erase it, so just keep that in mind. The fix isn't to panic, the fix is to get informed and adjust, which we're doing here today. And it is April 14th, last year's basically done, so go file, do your best, but in 2026, that one's yours to get right. If this helped you, please drop a comment, also share with any friends, and of course, if you haven't, please subscribe, because we do this all year, not just in April. Real money questions, answered honestly, no pretending like I've always had it together.